thought it would be great to start Mez up in '01 because it combines Oaktree's expertise in debt and also, if needed, in dealing with troubled situations.
Totally agree. In many ways, mezzanine was a step out from our high yield strategy. I explained mezzanine to some of our investors saying it is effectively high yield kind of risk, but for middle market companies. So we try to embody the same kind of risk appetite and the risk control that our high yield colleagues have been employing for many years now.
Can you describe that?
Mezzanine in particular, the risk, as you know, is similar to any other company, which is anything which affects the outcome. To us, the outcome is getting our principal back and getting our prescribed return back. In middle market land, there is some unique changes to how we perceive and experience risk. One, because of the size of the companies we invest in, things often get amplified. And second, all of our investments are illiquid. So because of the illiquidity, a lot more things could happen just because of the passage of time. And thirdly, because of the nature of the business, middle market again, there are some idiosyncrasies in the business, which I'm happy to elaborate.
Yes, I'd appreciate it if you would go through some of those.
The primary sources of risk for us clearly is what can affect the companies, which is what happens to customers, what happens to suppliers, the competitive environment, the regulatory environment, the overall market environment. The other source of risk which people don't really appreciate, and it is much more prevalent in our market, is the risk of how the stakeholders in a given company perform during a negative phase. What this means is, if you're going through a tough time, will the private equity owner do things which is more suited for their benefit at the expense of the company? So the other stakeholder would be the senior lender in the company. How will they behave? Will they panic? Will they take control? And the third risk clearly is what our partners in the mezzanine do. We're often the sole mezzanine investor in a company, but we do have partners sometimes.
Now, I always think that the first line of defense against counterparty behavior is not contracts, but it's picking counterparties well.
You could not have said it better, that picking the right partner is the foremost priority for us. And then we need to be extremely selective. We turn down 80% of the transactions we see. What does that mean to us? What it means is first isolating the variety of risk factors that could affect the outcome in our company. Once you isolate what we think are the variety of risk factors, then we sensitize our capital structure to make sure under a variety of outcomes from each of these risk factors will the company survive. And what does a company survive mean? It means to us that it has enough liquidity. It can go through tough times in a cycle, but that doesn't mean it's in trouble. As long as it's the right liquidity, we're okay. And thirdly, what is important to us to manage risk is proactive monitoring of the company.
What does that mean, proactive monitoring?
In mezzanine land, and where we make investments, we often get a board observer seat, which means to us that we can participate in board meetings with the company. So in addition to receiving monthly and quarterly financials, we get a very close look on how the company is being managed, and very often we can see signs of trouble creeping up just because we're in the board. But this is where we look at it from the company side.
That raises an interesting question. You mentioned the industries that you invest in. With a mind to risk control, how do you select your industries? What kinds of industries do you invest in and don't you invest in?
We tend to be industry agnostic, which is the general way in Oaktree. We are more company focused as opposed to industry focused. Having said that, there are certainly some industries where the risk factors are numerous and the range of outcomes for each of these risk factors is very wide. For example, we're very cautious in retail, we're cautious in real estate, we're cautious in companies where there's an emerging technology aspect to it. And the one common generic factor where we're really cautious about are those companies which have a secular trend to it. Because we can anticipate and structure around the risks we know, but a secular trend is something we really can't anticipate, which is amplified further because of the illiquidity.
Now, you've mentioned a couple of times the word illiquidity. illiquidity is a big topic in the markets today. Most people, especially in the credit world, feel that liquidity is down because the banks can't invest for their own accounts under the new regulations. How do you think about it and deal with it?
So, the recent changes to liquidity in the market is not a factor for us because our mezzanine investments, by the nature of them, are illiquid. So what is more important to us is making the right investments and making sure we proactively monitor them so we can catch any issues before they occur and take steps to remedy that.
Now, Raj, in the 15 years that you've been managing the mezz investments, unless I'm mistaken, you've never sold an investment.
That's probably true. I don't think we ever sold an investment.
Right. So we hold them.
We hold them
to term.
Correct.
And we are proactive in the outcomes.
That's very true.
Very
yes.
good. Very good. At Oaktree, we have a motto, which motivates the whole company. If we avoid the losers, the winners take care of themselves. How do you think about that on a day-to-day basis with regard to the group? And in short, is avoiding the losers enough?
Avoiding the losers in our market is the only way to accomplish a successful strategy for our investors. Right. The way we think about avoiding losers is stick to our knitting, invest in basic, stable companies, don't chase return. So one way to think about it is we look at risk return as a seesaw. One way is risk and the other say is return. And we do not believe that it's our birthright to get a high return irrespective of what the market conditions are. Therefore, when market conditions as they're today, when the return is lower, we tend to keep the risk the same and agree to a low return as opposed to going for a higher return and therefore increasing risk.
Right, right. I think that's very important. We don't reach for return.
We don't reach for return.
Now, one thing you haven't mentioned so far is that when we make mezz investments, we usually have the opportunity to buy some equity in the company.
That's very true.
At the same price as the private equity sponsor. Do you typically do that? And what's your thought process with regard to the risk associated with the equity?
Yes, Howard, we almost always buy equity when we make an investment in mezzanine, and the amount of equity ranges from 10 to 15% of the amount of debt we invest in.
I see. When we started, you and I, together 15 years ago, we viewed the situation as presenting a choice in operating method. Since a mezzanine investment is a hybrid investment, including, let's say, 85% debt, 15% equity, we have almost conflicting
Yes.
goals. Do we want to emphasize the avoidance of risk on the debt side, or do we want to emphasize the maximization of return on the equity side? How do you feel about that choice?
Without exception, we're always emphasizing the recovery and the return on the debt, which is one of the reasons why we limit the equity to around 10 to 12%, maybe 50 in cases, and that's what pays our bills. And in fact, 80 to 85% of the return in the mezz investment is from coupon, which is paid quarterly and in cash, which is what we believe is the right thing to do in our strategy. When you think about the debt and equity, there's two ways to think about it. An aggressive mezz lender would think about it as equity with a little bit of coupon. We, on the other hand, think of mezzanine as debt with a high portion of their income from coupon, with a little portion coming in from equity.
So I think that this is a great example of the Oaktree mindset. Risk is not a scientific component that you restrain through some mechanical processes. It's how you think about investing. And I've always been proud of the way the group operates because it puts risk control at a very high priority, maximization of return on a secondary priority, and has a very good record in terms of the avoidance of credit problems in its portfolio.
Thank you, Howard. We try very hard to stick to that mandate every day.